Hi. So in this video, we will be understanding what is a corporate debt market development fund, which is your category 1 AIF coming under your chapter 3C of the AIF regulations. So to understand from the name itself, we have understood one thing, that it is a development fund for the corporate debt market. So it covers your corporate debt market segment. Let's see, for this you need to understand a little bit about the stock market. So now this is the Nifty chart. Now when we look at the Nifty chart, you will see two significant things during the entire chart, right from its inception till 2025 it is there. Now in this you see that everywhere the stock market is going up is in the upward trajectory only. However, there are some setbacks that the market gets. Okay, like this was in your 2008 crisis. Okay, so when you see in the 2008 crisis, there had been a sharp fall. Okay, right where the market was around 5,000, 6,000 rupees, it fell directly to 2,800. So huge liquidity fall. Even when we see the time of COVID, in COVID what happened? The pricing was around 12,000 Nifty, and when it crashed, it went directly to 9,000. So a huge fall comes. Now what happens during these falls, if a person you've ever witnessed these falls, that everybody is in a selling. There is a full sellers in the market and there might not be any buyers in the market. So just like stock market, even in the debt market, debentures, bonds, etc., everybody is rushing to sell their debentures, redeem their debentures and get their money back, because they don't know what the future will look like and the future looks very dark. Okay, so that time they are saying we want to sell. Now if I have bought, example, if I have bought debentures of a mutual fund, I have bought a bond of a mutual fund, I will tell the mutual fund, I am selling it, please give me money. So there is a huge problem for the mutual funds, because what is happening now, the mutual fund will have to give the investors their money, because investors are selling the shares, they sell the bonds, and now the mutual fund has to repay them. To repay it, mutual funds normally will try to sell it to someone else in the market, take the money and then sell it out here. So if mutual fund someone has come to sell it, mutual fund tries to sell it to someone else. But the fact is, during market dislocation, market stress, there are no buyers in the market. Okay, or if there are buyers, only distress sale they are ready to buy. So mutual fund faces a huge amount of liquidity, cash problem. Okay, where we know it's a temporary issue. So the government of India, they have made an institutional framework, okay, called as the Corporate Debt Market Development Fund. So they have made a Corporate Debt Market Development Fund, okay, and government has put in money. Government of India has put around 30,000 crores in this fund, okay, and government has also told that certain mutual funds, the mutual funds will and their asset management companies have to mandatorily invest some amount, like around approximately 3,000 crores. So it had started with 33,000 crores in this fund, and this fund has been kept as a standby, that whenever there is a market dislocation, whenever there is a market stress, wherever there is a stock market crash and everybody is rushing to sell, then who will buy? Then these funds will be used to buy the securities, buy the bonds from the mutual funds. And one interesting thing is, they have said that you will not buy it at distress sell, you will buy it at fair market value. So this fund is obviously made in the form of a trust. This fund is made in the form of a trust to protect mutual fund industry, to protect the industry from sudden shocks. So let's read, okay. So the development fund, it's for the corporate debt market, because corporate debt market is a very crucial segment where people are looking for stability, and that is why I invest in a debentures, okay. So market dislocation is there, so then there will be a liquidity support, because mutual fund knows now they will tap the development fund and say that take these securities and give me my money so that I can give it to the investors. Okay. So this fund, what does it do? It instills confidence in the investors. It enhances secondary market liquidity. So whenever a mutual fund is looking to sell and due to a bad time nobody is buying, or they are buying a distress sale, then they can tap to this particular fund and tell them. Okay, and it is a backstop facility. Backstop means a secondary funding source. So normal funding, you try to sell it in the market, but if it is not available, then you have a secondary fund backup institution. Okay, now the interesting thing is this fund can be utilized only in case of market distress, only in case of market dislocation. So when there is no dislocation, where will these 33,000 crores be kept? So it can be kept in any FD, in any government securities. It can be parked. The buying and etc. will be triggered only when there is a market dislocation. Now who will decide whether there is a market dislocation is there or no? Like for example, in the stock market, even there was a fall in 2025, but that was not a market dislocation. For everywhere the stock market keeps falling, but that is not considered to be a market dislocation. SEBI will confirm that this is a scenario. So SEBI will notify that a market dislocation exists. That SEBI will determine and notify that a distress sale is there, and anyone wants, they can sell their bonds to the development fund. The development fund will be activated and they will purchase the corporate debt securities. So mutual funds and anyone who's holding these debentures, they can sell it to these particular fund. Obviously this fund is not a listed entity, it is a trust, so it is going to be unlisted. But with this money they will buy debt securities of listed companies, and SEBI will tell which all securities are there. Normally they say investment grade, means they will define which will be bought here. So normally where the maturity date is up to 5 years, those will be bought out. So 5 years maturity date is there. Okay, up to 5 years, max 5 years maturity date is there. Means what? Imagine when will the mutual fund face huge amount of liquidity crunch, where everybody is saying that redemption time is there, now you repay. So redemption is just around the corner, so people will want, imagine redemption is today, so the deadline is today for mutual fund to repay the units. So that time they will have to get the money. So that time they will tap this development fund and take. So they will get a liquidity support for sudden redemption pressures that they may get. Okay, so in short, if I have to understand what is the objective with an illustration. So if the mutual funds are unable to sell the corporate debt bonds due to market panic, market sale, etc., then the development fund will come in to buy those bonds, and they will buy it at fair prices and market prices, and therefore they will prevent distress sale. So this fund acts as a backbone, acts as a backstop, acts as a support to the mutual fund industry. As I told you, how did the funding support come? So 33,000 crores, 30,000 crores is from the government of India, 3,000 crores is from asset management companies or mutual fund, because ultimately mutual funds are helped in this. So SEBI will also say that mutual funds have to contribute at least 1-2% into this fund also. So that also can be done. So that mutual funds are ultimately, in case of distress sale, they have a buyer standing. Okay. So units of CDF are subscribed by AMC and government also. So this SEBI will say that at least they have to pump in money into this fund. Okay. Now in normal circumstances, okay, now normal circumstances means what? When there is no distress in the market, so where all this fund will be parked? So you will park, in normal circumstances, this money can be invested in government securities, treasury bills, any kind of guaranteed corporate bonds, etc., which the government will specify. Okay, and this is a close-ended scheme. Close-ended scheme means what? That this fund, how much of it is there, it is closed. securities cannot be issued. We don't want too much money lying just into this fund. So 33,000 crores approximately there, it's good enough. And it will have a tenure of 15 years. Okay. So what is the entire summary of it? If you understood the concept that whenever there is a stock market crash, some people are looking for this opportunity as a they are not looking at market crash, they are looking at all the stock market is at discount. So to ensure that the mutual fund doesn't face a problem of selling their securities at discount or not being able to sell, the debt market fund has been made. So that is it with the concept. Now we will just simply see the detailed provisions with it of what it is. More the key points I've explained you initially. So this is a corporate debt market development fund. It comes under chapter 3C of the AIF regulations 2012. It comes under category 1 AIF. It comes under category 1 AIF, alternative investment fund, which are normally any kind of fund which is beneficially, socially and economically beneficial for the country, that comes under category 1. The registration, obviously I told you, it will be formed in the registered in the form of a trust. So you will have to form a trust deed, there will be trustees, and it will be under Indian Trust Act 1908. Now to form the AIF category 1, a placement memorandum is sent to SEBI. Placement memorandum is a prospectus, and where all the details will be given about the fund, what it is, etc. And then it will be set up. Okay, so the tenure will be 15 years. Okay, so the tenure of this fund is 15 years, after which it will get renewed every time, every 15 years. It will be close-ended fund. Means once the money has been there, it will not have a variable corpus. It has a fixed corpus. That's it. So if they have 33,000 crores, it will be fixed inside. Okay. Tenure may be extended with SEBI's approval. Winding up also requires SEBI's approval. Now, very simple. Who will invest in these funds? Who will invest in these funds? I told you, first is the asset management companies only have to, SEBI will say that some amount you keep putting, it is ultimately for your backup only. You have to do, and government has also given the initial funding. Now, the next is investment. Now, one interesting question is that if they have bought these units, okay, they are standing as a buyer, they are buying these units. Later, when the market distress is over, when the panic is over, then they can sell it in the market again. Okay. During market dislocation, this fund will be activated, or SEBI will tell that this time is there, this is a market dislocation, and any mutual fund wants can sell their units, corporate debt units to this fund. So only it will be done if this fund can only buy from listed securities having a certain credit rating. So investment grade, so credit rating will be specified how much should be there. They will buy from mutual funds whose tenure is max 5 years, 5 years or less. Okay, why? Because only which are close to maturity or maturity has happened, mutual fund will feel redemption pressure in those units only. So redemption pressure will be faced when ultimately have to make the money. So when today I have to pay, tomorrow, within 5 years I have to pay. So those mutual funds will be in stress. They will tap the development fund. Okay. Now, holding and sale of the units. As I told you that this may hold a security till maturity, or ideally they will sell it after the market dislocation is ended. Okay. Investment in normal period, I told you in normal period they cannot invest anywhere. They will be dormant, and they will invest only in less, like government securities, liquid funds, etc. Okay. Pricing, now can they take advantage of the market crash and then buy at distress sale? So the answer is this is a trust, right? So they are not here for making abnormal gains, etc. It is giving a support. So they will buy at fair prices. Okay. And not at distress prices. Obviously, this fund cannot be used to invest in foreign company incorporated. We are not here to protect the foreigners. We are here to protect Indian corporate debt segment. Okay, investment cap. Now very interesting, they said you should not invest more than 5% in a single investee company. Now if a fund is there, 33,000 crores is already there, and some amount will keep coming from AIFs of other mutual funds, because it's like an insurance to them, right? So they are saying that one important, that they shall not invest more than 5% in any single investee company. So all these funds should not go in hands of one company only. It's common sense, just to protect. Borrowing limit. Now imagine at any point in time, if this fund needs to borrow, take more money to buy more mutual funds, so they can go ahead and take a borrowing also. Understand? If this fund is acting as a buyer, right? So they will act as buyers. So they might require fund, and 33,000 let's say is used up, or more money wants to come. So then they can even borrow the funds. So they are allowed to borrow the money of 10x, 10 times the value of the corpus. So 10 times of the value of the corpus during distress. Who will give a loan to this fund to buy mutual funds? Then will any lender want to give a loan during market distress? No. So, but they will give. Why? Because this loan will be guaranteed by the government under the guaranteeing scheme of the corporate debt, which is managed by the National Credit Guarantee Trustee Company, fully owned by the Government of India, Department of Financial Services, Ministry of Finance. So what I'm saying, that they can go and borrow. Now who will give them? Lenders can give them, because they are rest assured that if they cannot repay the loan, then the government is standing as a guarantor. So government will repay. Okay, simple points. Now there's one concept called as in specie distribution, which means you are distributing physical assets instead of cash. Normally when we give distribution of money, we will give money, right? We will give cash. This is only in case of winding up. This normally comes in case of winding up. In winding up, what happens? Instead of money, I can tell you, take the asset and go away. You distribute the physical asset. So if let's say there are some laptops, they will say you take the asset and go away. In specie distribution can be made at the time of winding up, subject to approval of SEBI and SEBI guidelines. Okay, if there is a change in investment strategy, only after approval of SEBI, disclosure should be made. NAV should be disclosed on daily basis, portfolio disclosure should be done, etc. Okay, now governance mechanism. Now that we are done with the concept, now only governance structure, just like how any other mutual fund or any other company will have to follow LODR regulation. It's a trustee, so there will be a trustee, manager, etc. 2/3 of the boards will be on independent directors. Audit committee should be there. A governance committee should be there, who will comprise of academicians, risk managers, independent market experts. So we're just seeing that who all is there, and for this good functioning, what all corporate governance measures have been done. Concept is over. Okay, listing. So the units of these funds will not be listed on any stock exchange. They buy the units of listed entities. Okay, because it's a trust ultimately. So governance, grievance redressal. So any grievance must be resolved within 21 days. Disputes can be resolved either through negotiation, through arbitration, mediation, conciliation. And with this, we have completed the entire concept of the corporate debt market development fund. Thank you.